Is a recession coming or not?
Well, the odds are increasing. We want to see more economic data. Some of the leading indicators they're mixed. Some are suggesting that we're in the very late stages of the business cycle.
But you're in the handicapping business, so handicap for us.
So our official model, our recession models, have been predicting about 40% chance of odds of a recession. That was before the latest batch of data. So, yeah, I would say the odds are a bit higher than that, maybe around 45% or so.
Hey, Scott, in terms of the numbers we're going to be seeing later today, we've talked a lot about this idea of good news and bad news. What is the Goldilocks number?
Well, I think you've seen the expectations being whittled down, even though the median forecast is around 145. I think the whisper is probably closer to 120, 125, following the weaker ISM numbers. That said, we do know there's a fair amount of noise every month. The figures, monthly change in payrolls is reported accurate to 110,000. That is a huge range of uncertainty. And in addition, this is September, so we got the school year. We're going to be, before seasonal adjustment, we had probably about 1.5 million jobs, and we lose all those summer jobs. So it seems a little silly to worry about the nearest 10 or 20,000 in the payroll number. You really want to focus on the 3-month average, and we have seen a slower pace of job growth this year. But bear in mind that we need less than 100,000 jobs per month just to absorb the new entrants into the workforce. So, these numbers that we're talking about, in terms of expectation, aren't especially weak. They're not as strong. I think we're kind of spoiled. We're used to seeing, 200,000, 250,000 per month. And that's just not going to be the case anymore. There may be a little bit of slack in the economy, but the trend is going to be slowing down over the next 10 years to probably about 70,000 per month. That'll be the new bogey.
But Mike and Steve, in terms of the way the market is thinking about this, if you saw a good, what I would think of traditionally as a good number, if you saw this number come in at 180 or 200,000, it might be considered hot even. Yep. Does the market say, fabulous, this is unbelievable, good news for the economy, we don't, she can take down a recession risk levels, or do they say, oh my goodness, the folks at the Fed are going to start scratching their head about what they really want to do?
I think we're in a moment where good news is going to be good news. It's going to be a comfort, I think, to the market that the labor market is not sliding more steeply. So I think we're right now, in fact, yesterday's news indicated we got this reversal in the market. We got this bounce that started in the morning. Bond yields hit their lows in the morning, even after a worse than expected ISM services number, which shows you that investor and trader psychology had run very far in the direction of more slowdown evidence is coming. And even when you got it, it wasn't enough to take the markets down. I also think the fact that we had the jobs number today meant people want to just kind of wait and see, even out positions last night, and just see if, in fact, we can get a decent number that's a comfort.
What a lousy jobs number, say, okay, forget it, let's reset this whole situation.
I think the market doesn't crave a lousy jobs number to get the Fed active, because right now I think the Fed is basically on this path already. So I think you want to keep it in the 6 digits possibly, but even below that you might be fine if you don't have bad revisions from prior months. You don't want to make it seem like there's this sort of headlong weakness.
And it's too
late.
But
if you do get a lousy number, then you get 2 cuts. So right now,
but the market already kind of thinks you're getting it anyway.
The market, to your point, yesterday when we bounced off the bottom, then the 2 cuts were back in. If you get a lousy number, you get the 2 cuts. But to Kathy, where were you on recession? You're at 45% now. Where were you 6 months ago?
We were closer to about 35% if we go back that far.
So you were always running a little hot. Yeah. In a normal state, where is it? 10 to 20? Is that normal?
It could be 15 to 20% normally, because you could have any exogenous shock that you're not anticipating, right? Some kind of war, oil shock, things get, push up recession. But I agree with your point that you want an employment report that's not too hot, not too soft. We're actually looking for 2 rate cuts, actually. So we've had September and December in our forecast for a while. So, anything beyond that, then I think it starts to get more worrisome for the markets. But 2, I think, it's not necessarily bad news.
I mean, who knows? A weak number, and then Steve talks to Eric Rosengren at the Boston Fed, who didn't want to cut last time, and today he comes out and sounds like he wants to. Right. Who knows? That might change the psychology a little bit. I think the very tricky thing is, the slowdown to trend growth that everyone has more or less said we should expect, this is kind of what it looks and feels like. And if it stops here, but if it continues weaker, then it's something worse.
Let me just add on to your point about Steve's interview that's coming up. There's a lot of Fed speak today. I think Powell's speaking. You're going to hear from all kinds of people all over the place. And if the Fed's the most important matter, I mean, is that what we need to be watching ever so closely?
Yeah,
to?
and Powell doesn't have a tremendous track record. I think he's probably 70-30, 70-30. You go with me on that, bad versus good?
I would,
so
but I would say the trend has been improving the entire way through.
October's not a great month for Powell.
I would say the trend's improving.
Last October 3rd.
Yeah, he's been much better the last several times that he's spoken.
Sure.